Every investor is ultimately trying to stay ahead of inflation. If you can't preserve the purchasing power of your savings, there's not much point in saving. In June 2022, CPI year-on-year inflation reached 8.9%, the highest in over 40 years. It turned out to be transitory, a word Fed Chair Jay Powell stopped using because for a while it looked like the wrong way to describe it. It was caused by supply bottlenecks related to COVID, but the big stimulus plan approved at the beginning of the Biden administration was also a factor. The government was at least partly to blame for the inflation spike. It's coming back down, but that doesn't mean investors can stop worrying about it. The US fiscal outlook has been deteriorating as long as any of us can remember. We're at 100% debt to GDP, the highest since World War II, and it's heading relentlessly higher. Things took a turn for the worse when the Fed had to raise rates. Because we have so much debt, monetary policy now plays an important role in how much it costs us to finance our debt. In just 4 years, the federal government will spend $1 trillion on interest expense. We're going to hit that unfortunate milestone 2 years earlier than if we hadn't had that inflation spike. Our ability to control inflation is now linked to our debt. This will make it harder for the Fed to control inflation. We need long-term rates below inflation, or negative real rates. This is how governments have managed excessive debt for centuries, through currency debasement. Nobody knows when we'll reach the tipping point at which our debt starts to be a problem, but when it does, you know the Fed will find reasons to increase their balance sheet. It's been coming down, but who really believes it's going to return to where it was pre-pandemic? They're sitting on $1 trillion in losses, and the negative carry between the low yields on the bonds they own versus the cost of financing is $100 billion a year. The Fed will never need a bailout, they just carry a deferred asset. But it means they're no longer sending profits to the Treasury, and this makes the deficit worse. The Fed needs to hold some bonds in order to carry out monetary policy. But anything in excess is really just a form of debt monetization. This is why investors should consider real assets. One example is energy infrastructure, where we invest. But real assets includes all kinds of tangible assets, such as REITs, airports, shipping ports, data centers, and power plants. These are the types of assets that are likely to preserve their value if inflation does trend above the Fed's 2% target. When interest rates start to slow economic growth, as they surely will, given the fiscal outlook, America will always choose growth above all else. And the nice thing is that real assets are less and less correlated with the stock market, in part because the S&P 500 is increasingly dominated by the 7 mega-cap stocks. Put another way, if you don't own real assets, ask yourself if your portfolio is compensating you properly for the inflation risk you're taking. If you're interested in learning more about the energy sector and interest rates, then don't forget to subscribe and follow us on LinkedIn and Twitter. Our handles are in the description box below. To find out more about what we're thinking, you can sign up for our twice-weekly blog at sl-advisors.com. We always love to hear from you, so if you have any comments or blog ideas, please leave them down below. I'm Simon Lack. Thank you for watching this video.